Ladies and gentlemen, welcome to Woodburn Accountants and Advisors China webinar series on managing your accounting and tax in China. This is a 5-day webinar series, so we'll be doing one session each day of this week from 10:30 a.m. GMT to approximately 11:30 a.m. GMT. You have joined us today for part 1 of this series, where we will be looking at the benefits of the preferential tax policy for SMEs in China. The biggest part that I will be explaining in this series is about tax planning, particularly if you are a newbie or a startup in the Chinese market. For those of you that are interested in joining the other 4 sessions, tomorrow we'll be talking about VAT, Wednesday about tax audits, Thursday about implementing internal control systems, and then on Friday about profit repatriation strategies. So, as some of you might know, if you're familiar with these webinar series, I always like to get an understanding of who my audience is. This is a brand new series, so even those of you that have joined before, please participate and interact with me. What I would love to know is whether you are a newbie, a startup, or an experienced China hand. Newbies are usually those of you that have not transacted in China yet. You have found an opportunity and you're trying to gain a certain level of information, or maybe even put pen to paper and create your business plan for the Chinese market. If you are a newbie, type in newbie into the chat section of the control panel. If you're a startup, that usually means you've been transacting with China for a certain period of time, or you've even implemented your own entity in China. If you are a startup, please let me know. Type that in also into the chat section. And experienced China hands would be those of you that have been in China for over 10, 15 odd years, and you're just on here basically to get new and fresh ideas. And I always welcome those people as well, because I also join other people's webinars to gain a further understanding on my own education. So please type in who you are. It's fantastic to always know who the audience is. So Leon typed in newbie startup, Rizal typed in startup, because that also gives me an inclination of how I'm going to direct this presentation today. So I'm gonna make the assumption that a good portion of you are startups. In addition, I would love to know who of you are finance managers and who of you are non-financial individuals. This will help me with the terminology that I'll be using in today's session. So if you can type in finance or non-finance, that will give me an understanding of who you guys are as well. Rizal is finance. All right. Anybody else? Leon is finance. Sarah, Philippa, Paul, Matthias, Biden, Anne, please, please, please give me feedback. I've just highlighted a couple of names out there. It's always really good if people interact with me. It also makes the presentation a little bit more fun. So Paul's not non-finance. Anybody else? Okay. Sarah's also non-finance. So it's 50-50 right now. All right, I'm going to continue on with the idea in my mind that we got a 50-50 group of people here. So the whole point of this webinar series is really to educate you about the accounting and tax environment in China, with the idea for you to be able to do certain levels of tax planning, particularly for 2021, to also think about how you may want to structure your transactions, how does simply VAT work, which is critical for anybody who's doing transactions in China, whether direct from overseas or within the territory. And then also ultimately how to protect your business. And obviously the biggest question that most companies have is, how do I take money out of China? And that's going to be Friday session. So I'm here to educate you. But these sessions can be so boring, quite frankly, when you're talking about accounting and tax, that interaction is really key. So if you've got questions, if you've got comments, if you need clarity on something that I've highlighted, insert it into either the question section or chat section of the control panel. That will have, then we can have, first of all, a very good Q&A. And usually the Q&A is the best part of the webinars, where it also ties the whole subject together. But this is 60 minutes of your time spent, right? This is a free webinar. I'm educating you guys free of charge. Use your time wisely in terms of asking all the necessary questions you might have. Who am I? Well, my name is Christina Kohler-Coluccia. I'm the head of business advisory at Woodburn Accountants and Advisors. My expertise has been basically, my entire career actually has been spent in China, specifically in Shanghai. So that's been 17 years of purely corporate services and compliance work in China, helping 100% foreign investors that are expanding into the market. I have helped probably over 500 international companies with their entry, their operations, their implementations, their strategies, and predominantly their growth in the Chinese market. And I'm also the creator of the China Roadmap methodology, which, if you're interested in understanding how the roadmap works, what are the bullet points and checklists you should be ticking off for your operation in China, whether that means doing business directly in China or even just operating an entity in China, then join me on the 8th of December. The webinar is already up on our website, woodburnglobal.com/events, which I can type in right here, and you can register for that event immediately. Again, free of charge. That is going to be a more interactive event where I'll have a handbook and checklists and whatnot for you guys to think about. So go ahead and register for that if you wish. All right, so we are going to be talking today about the tax system in China, specifically about corporate taxes in China, okay? So I want to start off with a bit of terminology so that for those of you that are non-finance people, you'll understand where I'm coming from, because I will switch around the terms quite often as I'm speaking. For those of you that are finance people, this is going to be a piece of cake. But just so you know, in China, you've got corporate income tax, CIT, enterprise income tax, EIT, or profits tax. They all mean the same thing, which is profits tax, okay? But you'll find that some service providers use CIT, others use EIT, others just say profits tax. It is very simply all means exactly the same thing, and I'll probably be using all three phrases throughout today's presentation, okay? Other important things that you need to be aware of when you're talking about the tax system is that China's fiscal year is January to December. So that means that is the calendar year. That means that corporate income tax is paid quarterly. So the declarations are done in April for Q1, July for Q2, October for Q3, and January of the following year for Q4. In addition to that, you've got annual corporate income tax filing, which is basically the overview of the whole 12 months that has to be declared in April of the following year. Okay, so we're in 2020 right now. For Q4, the filing will be in January, and the annual filing will be done in April of 2021. Okay, so these are just very simple rules. If you guys are going to ask me, can I change the fiscal year? You can only change the fiscal year if you're a Fortune 500 company and you do a very stringent application with the State Administration of Finance and Tax, okay, the SAT. So ultimately, if you're a small, medium-sized company, which is the direction of this presentation, you can't change your fiscal year. It will be January to December. These are all the corporate income tax rates. So I very succinctly put it into a table for you so that you are able to identify where you all might be falling into at some point where you guys might be profitable in the Chinese market. The standard corporate income tax rate is 25%. Okay, this is where you'll see this all in the media. Then you've got where I'm going to lead on with today's presentation, which is small scale enterprises. This is if you've got an annual turnover of less than 3 million. From January 1, 2019 to December 31st, 2021, so we've got basically another month, a year and 1 month of this, you can pay a 5% corporate income tax if you've got an annual taxable income of less than 1 million renminbi, and then 10% profits tax if you've got an annual taxable income between 1 and 3 million renminbi. And then if you hit over 3 million, it is at the 25% rate, which is the first line item, okay? If you are able to fulfill all criteria under the high technology enterprises, the rate is 15%. If you're a technology advanced service enterprise, it's also 15%. If you are a company that is registered in certain jurisdictions, i.e. zones, you can also get a 15% tax rate. If you are in the key software production or IC design, you can enjoy 10%. And then companies that are engaged in pollution prevention and control, it's also at 15%. I just want to highlight here, for everything that is under line item 3 and below, so high-tech enterprises and below, there are very strict criteria that you need to fulfill. Companies engaged in encouraged industries, this is basically modern service sectors versus trade. And then that's in Shanghai, Zhuhai, Pingtan, and in many of the Western regions, okay? And I want to highlight something about these zones as well to you later on. But this is basically the table which encompasses everything in relation to corporate income tax in China. And the big question then is, under which category do you fall under? But the biggest question you need to ask yourselves all is, when are you planning on being profitable? Okay, tax should only be one of your considerations when establishing your entity in China, okay? Because there's so many other considerations that you are going to have to make. But if you are planning on having a structure in China that is going to be purely a cost center, then the whole concept of corporate income tax isn't going to come into play for you. Or it certainly won't come into play for the first 3 to 5 years if that is your strategy, to be a cost center for the first 3 to 5 years. Okay, I just want to repeat that point because there's a lot of confusion in that, especially as I'm talking to newbies and startups in China. When are you planning on becoming profitable? Okay, this is all part of your tax planning. If you are planning on purely being a cost center for the first 3 to 5 years because your revenue will be earned in your head office, then this question of where you fall under in the whole table here of your corporate income tax doesn't come into play because you're doing a zero declaration. All right, I hope people have understood that aspect, okay? The key thing is making sure that you do your budget to understand at what point you will be profitable, which is why I always tell people, create a budget that is not just for your first year of operation, but create a budget that extends to at least the first 3 to 5 years of your operation so you can see where you are going to be profitable. And I have given here today a tax planning exercise for you all. Where I've actually displayed an example so that you get an understanding of this, because I want people to understand when they are going to be profitable. The next consideration is obviously, are you a high-tech company? Are you a technologically advanced company? Will you decide your tax planning based on location? So like I said before, you know, if you look at companies engaged in encouraged industries in certain regions, if you decide, okay, I want to set up a company in Shenzhen, should I just go ahead and set it up in Shanghai because I get automatically a 15% tax rate? Well, don't do that if, first of all, you're not planning on being profitable at all. And second of all, if your operational office is not going to be in Shanghai. Okay, the same I can say for Zhuhai or Pingtan, all of these Western regions, if you're not planning on having actually your operational office there, but you're purely choosing that location because of the 15% tax rate. And actually, when you do your tax planning, you realize you're only going to become profitable in 10 years. Well, what's the point? You're not choosing the location for the right decision, key considerations. Okay, and don't forget, you can always change location. Okay, what I want to make sure is that you are choosing the right locations for your operation right now with the consideration of knowing when you might become profitable. All right. And obviously, are you a production software company? Are you a clean tech organization? And then point 7, which we're going to really go into detail with on Friday, is are you planning to implement repatriation strategies? Meaning, before you're profitable, are you planning to repatriate funds overseas so that actually you're not paying profits tax in China? You are repatriating funds before you do that. If yes, which I hope everyone said yes to that question, then when are you going to do it? Are you going to do it straight from the beginning? Are you going to do it in year 3, year 4? When are you planning on starting that implementation? Okay. And does that actually mean that you are only going to be profitable in China then even later? So beyond the 5, 6, 7 year time frame. All right. This is all part of your action plan now to answer those questions and have an understanding of what is your organization in China, and then start doing this tax planning aspect, which is a fundamental part of creating your budget as well. Now, as I said, small scale enterprises in China, if you have an annual taxable income of $1 million, it's at 5%. If it's at 3 million, it's 5% on the first million and 10% on the next 2 million. Okay, that's the actual detail regarding this. But you have to keep in mind, the question is, are you going to be profitable today? Are you going to be profitable in 2021? Actually, here's a question for all of you. For those of you that have entities in China, will you be profitable in 2021? Can you write yes or no in the chat section? You should already have an inkling. We're almost at the end of November. There should have been some budgets created. Will you be profitable? Nobody's reacting to me. Why is that? Come on, guys. I know it's Monday morning. Well, it's Monday morning for me. So Paul said no. Well, okay. Well, I'm going to use Paul. I'm going to use you as an example. Well, in that case, this whole preferential policy for small scale enterprises will still not apply to you. And potentially, this benefit will expire in December 31st, 2021. Okay. So even Rizal said no. So, and obviously the biggest question you've got to ask yourselves is, will the Chinese government extend this policy for small scale enterprises in China beyond 2021? I cannot answer you that question. That is the question mark for all of us. If I had to give you a common sense feeling, my common sense feeling would be that because of COVID, they would extend it. But I can't guarantee that. I don't know. That's just my personal gut sentiment. Okay, but this is where the planning comes. So Paul and Rizal, for you, if you're not planning on being profitable in 2021, this whole small scale enterprise thing doesn't pertain to you at all. Okay. For those of you that need more understanding about, oh, sorry, I wanted to highlight here before I go on to some of the terms and definitions. I wanted to provide just an additional example for those of you that might consider yourself as high new technology enterprises. These are the criteria that you need to fulfill in order to be able to get the 15% tax rate for corporate income tax. So the first point, which I highlighted in red, is the fact that you're eligible for the 15%. The second point for me is critical for you all to understand. It basically means that your core IP will be owned by the Chinese company. Now, if you're planning on developing a repatriation strategy where your overseas entity owns the IP, and therefore you've got licensing agreements between your overseas company and China, then you won't be able to fall under this category of HNTE because your overseas company would be owning the IP. Okay. You also have requirements about employees and also R&D development. So keep all of this in mind when you are thinking about applying for the HNTE. I also want to emphasize here that even though you make an application, It doesn't mean that it's guaranteed. And the vicious cycle is the fact that you have to incorporate a company in China. You have to do your local district registration with your district tax bureau before you can start your application to have this status. So although you may have made a budget with the assumption that you got the 15%, be very conservative about getting that rate because it is an application procedure. And it doesn't necessarily mean that even if you fulfilled this criteria, you get it, okay? These are the types of companies that fall under the HNTE, which is cloud computing, mobile internet, encryption, e-commerce, inspection, cultural and creative sectors, natural disasters, alert and emergency solutions, all right? But I wanted to go into a little bit more about the definitions, right? So those of you that are non-finance people, as I highlighted on this slide, I'm highlighting that the 5% rate is based on the fact that you have an annual taxable income of 1 million renminbi. So what is annual taxable income, right? Let's define that here. So the taxable income is actually the amount of income used to calculate how much tax a company owes to the Chinese government in any given tax year, okay? Or even in any given quarter period, all right? And it's generally described as adjusted gross income. So what this actually means is that it is your total income minus any deductions or exemptions that have been allowed in that tax year, okay? So if you've been provided deductions or exemptions, for example, this year, due to COVID, deductions and exemptions have been offered, and I want to highlight that as well in this presentation, then you would deduct those from the gross income, okay? And also very important is who is considered a tax resident in China. So obviously, if you have incorporated an entity in China, that entity is a tax resident. Okay, so if you have a limited liability company in China, you are a tax resident, okay? For those of you that don't have entities in China, but you are transacting with China, then you have to analyze where the effective management is for that China business. You also have to look at whether you have I've written here agents, independent agents, whether you have people on the ground that are working purely for you, but are not employed by a Chinese entity that you've set up, then you have what is called a permanent establishment in China, and corporate income tax will apply for those contracts that those independent agents are servicing, okay? And this is where I want to highlight that, you know, corporate income tax is not just applicable to those companies that have an establishment in China, it's also applicable to those companies that have a permanent establishment in the form of independent agents that are usually, the standard with most double taxation agreements is 6 months, that have been working in a fiscal year, so in a calendar year, more than 6 months on a project on behalf of an overseas company, then permanent establishment would be created and corporate income tax would have to be paid in China based on that contract between the company that is being serviced and the overseas entity. Right? If you've got questions about permanent establishment, please do let me know. Now, in relation to COVID regulations on corporate income tax, a lot of the regulations are pertaining to companies that have been severely affected, like the hospitality sectors, but also those that are in have been helping with the medical profession, okay? So what I want to, first of all, highlight here is the payment of corporate income tax, especially for those that have revenues that are under, annual taxable income that is under 3 million renminbi. The corporate income tax can be deferred basically throughout this year. You have the opportunity to defer it to Q1 2021. Okay, so if you have found yourself to be profitable in 2020, you have the ability to actually defer your quarterly profits tax payments into the Q1 2021 filings. All right, so that's number one. I'm not sure if anyone is actually being profitable in China, but just be aware of those aspects. So other key aspects that I just want to highlight off of the next few slides is obviously if you are in the sector that is helping with the epidemic, you get special regulations applied to you in relation to corporate income tax. But probably in terms of everybody else, in theory, you know, if you look at the second item, basically all the losses that are carried within 2020 are extended for 8 years versus 5 years. It says here it is for companies that are really in the hospitality sector, but currently, at least in Shanghai, it's pertaining to everybody. Also, in terms of COVID-19 related tax losses, if it's been incurred by high-tech enterprises, it can be carried forward and offset for 10 years, okay? But you need to have that criteria established. On this slide, what can I just highlight out of there? It's probably item number 3. So for companies that are small, low profit enterprises, again, under 3 million, the effective corporate income tax is reduced to 5% and 8.4% versus 10% previously, okay? So keep that in mind as well. And then these are really just in terms of cash and goods donations, etc. So I don't think that will apply to very many people. If it does, let me know, and I can provide you information on that. So what I also wanted to highlight in today's presentation is what deductions are allowed or what tax credits are provided to companies when looking at corporate income tax. So the first one, which is applicable to everybody, is expenses. So expenses, costs, and losses, right? So I don't know if you're aware of this, but entertainment expenses are 60% deductible, up to 0.5% of the total income. Advertising is also deductible, up to 15% of the total income. And donations are also deductible, up to 12% of the total income. What is not deductible are dividends, management fees, corporate income tax, or late tax payment surcharges, okay? So this is important to think about when doing your tax planning, because, for example, management fees are one of the repatriation methods to be able to get money out, okay? There's also a deduction on intangible assets like patents, trademarks, copyrights. Intangible assets can be amortized over a period of at least 10 years. Again, this is going to be more for finance people versus non-finance people. So I apologize for those of you that might not be finance people. For those of you that are startups, the organizational and startup expenses are also tax deductible fully in the first year of operation. But here's a question I'm going to highlight to you. When you are setting up your company in China, when you're in that startup phase, actually all costs are paid from the shareholding entity. And one of the questions that I ask companies is, do you want that the overseas company, the shareholding company, issues you an invoice to reimburse for those organizational and startup expenses? Or are we just going to forget it and it's going to be booked under the shareholding company? There's no right or wrong answer here. I think the larger the size of the company, it could very well be that the shareholder, in order to consolidate all costs related to the China operation, they will issue an invoice for the reimbursement of those organizational and startup expenses. And as I highlighted, that's all tax deductible in the first year of activity, okay? So there's no right or wrong. Like I said, it's going to be an internal decision that's really made with the finance team in the head office as to whether that will happen or not. Then you've got interests on loans, which are also tax deductible. And if you are hiring handicapped staff, that's also deductible. So 200% of the salary expenses paid to those staff are deductible as well. R&D expenses are also tax deductible as an incentive up to the 31st of December 2020. So, and it will be ending now. And as I said, tax losses can normally be carried forward for a maximum of 5 years. However, the year for 2020 is up to 8 years. Okay. And then obviously there are preferential tax treatments, as I highlighted in my table, for those companies that are HNTEs, those that might go into special economic zones or pilot free trade zones. And then there are also exemptions applicable if you are in the agricultural, forestry, fisheries, software, and infrastructure sectors, as I also highlighted on that table. Okay, so keep that in mind, really evaluate the sector that you are in. Other corporate taxes. So I've listed here all of them. So just very quickly, if you are purchasing a property in China for your business, there's the real estate tax, deed tax, urban and township land use tax, and the real estate and net development costs, which have an appreciation tax. Then you've got the basic payroll, right? The 20% of the basic payroll is part of the social insurances that are paid out. And then you've also got the urban construction and maintenance tax, which is an indirect tax that's calculated on the VAT and consumption tax. I've highlighted here in red one item which most people forget, which is the stamp duty tax, which is levied on all legal documents that are signed with the Chinese company. So the first legal document that a newly incorporated company signs is the lease agreement. So you've just got to remember that in any of these type of legal agreements, stamp duty will be applicable. The rates vary, right? I mean, it's minuscule amounts, but if you don't do it or you forget to do it, the penalties can add up because there's a daily penalty rate. All right, so just remember the red item there in regards to the stamp duty. Then obviously you've got motor vehicle acquisition tax if you're going to start purchasing company cars. You've also got a tax that is levied on entertainment and advertising businesses, and then taxes on environment and natural resources. So these are all the corporate taxes that are applicable depending on the sectors that you are in and actually what your strategy is in terms of real estate, in terms of car acquisitions, etc. And so keep that in mind. So now we're going to get into what I actually think is the fun part of today's presentation, which is the question of when will you be profitable in China? Okay, so I put here a 5-year tax planning, and I'm going to go, there's a lot of words on this, but I will go through this with you one by one. It took me a while to create this, and it might not be 100% perfect, but I wanted to get people an understanding of how they should be thinking about their corporate taxes, okay? Particularly if you're a startup, you're newly incorporated, how are you going to manage your registered capital against income coming in, against profit repatriation strategies, against roadblocks that cost money, etc. Okay, so let's work through this, okay? And again, this is just a case study. I really haven't put this against any company that I've been working with. I just wanted to make it very simple for people to understand. Okay, so let's say year one. Well, we're now in, so this was my reasoning. We're now in November 2020. So let's say you're incorporating, you're starting the incorporation process of your company now. So let's make the assumption in March 2021, your business license will be issued. So probably by May, you will have the opportunity with your bank accounts being opened that you can send over some of your registered capital. So let's say you have designated your registered capital, which is the working capital, which is $100,000 US. So let's say about 650,000 renminbi. The capital, this working capital, is going to be used to fund all local expenses, which is rent, salaries, reimbursement of expenses, I don't know, buying spare parts, buying product, etc. Okay? In year one, what you really need to think about, because you're thinking about it from the period March 2021 to December 2021, is Will the China company repay the shareholder for all upfront costs for the setup of the company? And again, there's no right or wrong answer. There's just a question. But what you need to do as a calculation is say, I've got 656,000 renminbi to spend on building up my company. Okay. Do I have enough of that capital to pay off the shareholder for all of the upfront costs? That's the question you should be asking yourself. Ideally, that's a question you should have asked yourself when you were creating this number of the registered capital, okay? But if you haven't, that's a question you need to ask yourself upfront right there and then, okay? And obviously, the biggest point will be whether the shareholder requires you to do that or not. So let's say year one, March 2021 to December 2021, you've been building up the business. You've got, I don't know, 2 or 3 people on your payroll. You've got an office. Your employees are going out there because, right, China's open for business, so people are able to travel within the country. There's a lot of business development potential that can happen locally. So you're going to have local costs that are going to get accumulated, okay? And you're using this working capital to pay it off. Now, I'm going to give you the biggest mistake I've seen in 2020 this year with a newly set up company where the employees got lazy in providing their expenses to us because we're their accountants. And trust me, the amount of follow-ups we've done has been tremendous. Until after the October holiday, we suddenly get an email that one employee has spent over 200,000 renminbi in expenses for all traveling costs associated with the business development of the company since Jan 2020, so 10 months. Suddenly, the company has to, first of all, reimburse over 200,000 renminbi worth. Now imagine, they only have 656 in their bank account. Okay, probably by now, they don't even have 656 left because they've been paying salaries, been paying rent, right? So they probably don't even have capital to pay that back. But what's even worse is that from an accounting perspective, you're getting the whole 10 months worth of expenses up front, and now you have to backtrack and separate it month by month because you want to allocate those expenses to the projects that were being developed in those months, right? It's a lot of work from an accounting perspective. So first of all, the company is suffering because they have to pay out 200,000 up front instead of having had the opportunity to have split that out over 10 months. And number 2, the accounting firm, us, we're going to be spending a lot more time on sorting through those expenses, which just simply means our invoice to the client will be so much higher because of our time spent required to fix all of that. It is important, and this is why on day 4 we're going to be talking about internal control mechanisms, right? Implementing internal control systems because of this one case study that now popped up in October, and where we've now set very severe, or the company has thankfully set up very severe guidelines. I mean, this individual cannot get repaid right now. They're going to have to wait. And it was their mistake, so they're going to have to wait. They've got the month of October reimbursed, but everything basically January to September, they're going to have to wait until capital will be received within the organization, okay? But this is very important for year 1, is to set up those internal control mechanisms that you don't pop up into this situation because your staff members aren't following the rules, okay? Then you get into year 2. So year 2 is going to be January 2022 to December 2022, right? My recommendation is always at this point, after you've done kind of your first year, your first fiscal year, start thinking about those repatriation strategies. And I put that as point number 1 because it takes a long time for the tax bureaus to approve these contracts. So whether you have a trademark licensing agreement, a management fee agreement, a marketing fee agreement, whatever it might be, it can take a very long time for the tax bureaus to approve these types of agreements. And obviously, it's clear that you are going to be sending money abroad, right? China doesn't want you to send money abroad, okay? So they're going to go through those licensing agreements or management fee agreements like a fine-tooth comb to make sure you've thought about transfer pricing, that you've thought about additional margins, that you've thought about the hourly rates according to what is the standard in China. They will check all of these things, okay? And usually you have to have the expectation in your mind that to get these repatriation strategies set up, the application procedure usually is between 3 and 6 months. I always say get them approved up front, think about them up front. They can always be changed and then reapproved, but the final master agreement is going to be approved, right? So you can always make minor amendments along the way, but at least get them approved so you've got it done. That when that first invoice is issued, you don't have to wait 3 to 6 months to make that payment, okay? So from an operation, so that's number one, is really initiate those repatriation strategies. Think about the transfer pricing arrangements within those agreements as well. The next point to think about is your working capital, which has been used since March 2021 to March 2022 to grow headcount, pay for rental charges, pay for professional service fees, pay for product, whatever it might be, and it's almost running out. And the China company begins invoicing locally to customers. Revenue starts coming in, but definitely not enough to sustain the business. So what do? The last thing you want to happen to your organization is that you can't pay salaries, because the last thing that you want is turnover of staff. Okay? You want to make sure there's always going to be enough capital within that bank account that you can pay for salaries, rent, and professional service fees. You also don't want to lose your accountants, okay? If you're outsourcing to accountants or your lawyers, because you can't settle their fees, all right? You don't want to get kicked out of your office because you can't pay the rental. And you certainly don't want to lose your staff because you want to maintain momentum within your organization. So the question comes, how do you get money, right? Revenue starts coming in, but it's definitely not enough. So you have a couple of options. You can increase your capital. So you increase the 100,000 USD to, I don't know, 150, 200,000 USD. Downside to that is that you're increasing the liability to your company. Or you bring in the foreign debt loan, which is the difference between your registered capital and total investment, right? Or you create, and I'm going to use the word fake service agreements in order to be able to obtain funds quickly. By creating fake service agreements, you will have a liability, a risk, because there's no authenticity to those agreements. And if tax bureaus require additional, or auditors require additional proof, you won't be able to provide that. Okay? So this is why, even before you start your company, but even, just generally speaking, the budget is so critical, because you want to create a registered capital amount where you can sustain your organization long enough that the revenue that the income that you are earning can sustain the business. I don't want anybody to have to go through that pressure of suddenly having to increase their capital and then also increase their liability, to have to set up a loan account to get the foreign debt loan. The loan account process at the bank is frustrating. You can only set it up once you've got the loan agreement on hand, or even to be in a situation where you're creating fake agreements. I don't want anyone to have to create fake anythings in China right now, okay? You don't want to get yourself into that situation. But these are the 3 solutions that I offer you in case you do, right? And I can tell you there are a lot of companies who do, all right? You're not going to be the only ones, all right, that have actually miscalculated their registered capital amounts. But this is where the budget aspect becomes so critical, all right? And you have to make certain decisions as well. I mean, so far, I've been fortunate enough that no clients have made those decisions, but when capital comes out, in theory, is one of your decisions to let go of employees, to lower the headcount. It's a pity to do that because you will lose momentum, right? Does it mean that you move office spaces in order to have a lower rent? there's so many considerations you're gonna have to make, right? The key aspect from year 1, year 2 is that you don't want to lose momentum in your business, okay? So you've got to have enough capital on your fingertips to be able to pay for everything. Then year 3 starts. So year 3, that's 2023 now. Revenue is still not enough to sustain the local company because you are increasing your local expenditure for marketing and brand awareness. You might have already done that in year 2, might I add. Okay, but I wanted to throw a spark in there for year 3. So you might all of a sudden be like, wow, we've got great momentum. Let's have a boost in terms of marketing and brand awareness and essentially headcount. Okay. Does that mean you've got enough capital? Do you need to get more capital? Okay. Now I want you all to remember year 3 might be the year where you are just, because you've already been in the market for a year and a half, you're using year 3 because now you've got knowledge, you know how things work, you know how the business is running, you've got solid, loyal staff, you've got very little turnover, you are able to really push now. And potentially you also want to expand your sales channels. Maybe you want to start e-commerce, maybe you want to have a retail store, not just building up on the marketing and brand awareness. Okay, so you have a choice. Either you cut down other expenses to cater for that increased cost, or you need more capital. So again, how are you going to get that capital? Now I just, again, want to highlight here, you're in year 3. This is 2023. You're still not profitable. You're actually only spending money. So everything that I've mentioned so far in this presentation about the tax rates, the corporate income tax rates, that table that I highlighted, doesn't apply to you. Okay, still in year 3. This is 2023. Who knows in 2023 what tax regulations will exist for corporate tax? I have no idea. I have no clue. I don't know what's going to pop up because there have been so many changes recently. I don't know what will come in 2023. And I think it's very, very difficult for people to make that assumption. So let's go on to year 4. Okay. So year 4, 2024, revenue is almost at a level to cover all expenses on a quarterly basis. There are fluctuations month to month, obviously, but quarterly is covered when profits tax needs to be declared. Okay. If there's any excess on a particular month, do we keep that in account and therefore in that quarter we pay profits tax, or do we repatriate? I'm not going to answer that question. That depends on you. Depends on your current status of your organization. Okay. Does the shareholder at this point want to reimburse for the startup costs? Have you initiated your trademark licensing arrangements? Do management fees have to be paid overseas? You are going to be having a little bit of excess. So the question here is, and that will fluctuate quarter to quarter, but if you do have that excess, what are you going to do with it? Are you going to keep those funds and then be eligible for corporate income tax? Obviously, it's not going to be excessive, but it'll be something. Or do you repatriate? Do you start initiating those agreements? Okay, and this happens throughout year 4, throughout 2024. All right, so what are you going to do when you start having that excess? Okay. Year 25, this is now, we're in 2025. Okay, and just to highlight for year 4, obviously, we can definitely say for certain, if you are a normal organization, your corporate income tax rate will be 25%. So do you want to pay 25% on that small excess, or do you want to repatriate that out? Obviously, if you're in a certain region, or if you're in a certain sector and you have been able to get the lower tax rates of 15 or 10%, the question will be whether those still exist in 2024. The benefits for the SMEs, that's only going up until December 2021. So I have no idea whether that will continue after that. Okay, but you got to make the assumption then 25% at that point in time for that little excess that will be then earned. Okay. And do not, can I just also emphasize here, if you do initiate those arrangements, please do them right at that point. Don't do it, after the tax has been declared. There's no point, right? There are strict deadlines in terms of tax declarations. This is why I'm telling everyone, and I'm going to repeat it here. You have the opportunity, because of VAT, to create financial management reports on a monthly basis. Please review them on a monthly basis, because then you can make decisions right there and then about whether you should initiate these licensing arrangements. Don't wait till the end of a quarter period, and then you have 10 days to declare your tax and you have 10 days to initiate this arrangement. It's not going to work. Too tight of a time frame. Do it as you're seeing the management reports. You've got to make decisions as you're seeing the management reports on a month-to-month basis. Do not wait off on that. In terms of year 5, right? We're now in 2025. Revenue is above all expenses and repatriation strategies, and corporate income tax needs to be paid on a quarterly basis. So the biggest question I have for 2025 is, what will be the tax rate in 2025, right? Are there ways you can minimize your tax exposure through the repatriation strategies? Or will there be new guidelines, for example, for SMEs or for whomever, regarding lower tax rates compared to the 25%? All right. In addition to that, and I'm going to leave this hanging in the air, is we're now in year 5. It's 2025. Should we be considering to minimize our tax exposure, or should we just simply pay something in terms of corporate income tax? Why did I bring up that question? I bring it up because 2025, that's year 5 of operation. If you're still not profitable in year 5, or not even, you're still at the break-even point, right? Because you're developing all these repatriation strategies to get money out. Will the tax bureau or your tax officer, will they approach you to say, why are you still in China in year 5 if you're still not profitable? I let that question hang there. So this is the issue, right? And this is why on Wednesday, I'm going to be talking about tax audits, right? You should be strategic about your tax planning. You cannot never pay tax. I wish that would be ideal for everyone, wouldn't it? That no one had to pay individual income tax, that no one would have to pay corporate income tax, that there would be no VAT. I mean, we would all want to have a world with no taxes, but this world would not survive without taxes, okay? Without government funds to help. So the question is, if you want to avoid a tax audit, or if you want to avoid a red flag from the tax officer, perhaps it is better to just declare something by year 5 so that there's no questions raised. And what I'm saying is, you keep the repatriation strategies, you keep the corporate income tax, you pay something. I'm not saying to pay an excessive amount. I'm saying you pay something. And that way you go through the process of then putting funds in a reserve fund and then paying dividends tax later on. I'll go through all of that on Friday's session if you don't know what those terms are, okay? But the question is, maybe year 5 is that threshold period where, yes, we can create so many repatriation strategies that we never have to pay tax in China. But the question is, shouldn't we just be paying something so that we avoid not just a tax audit, but we avoid the suspicions, that we avoid somebody going into the company to look at our books? Now, if the reality is that still by year 5, you're not profitable and you haven't initiated repatriation strategies, you have to analyze your business because something is wrong. Either your costs are too high or there's something that's not right there, okay? By year 5, that's usually the threshold where people should be going past the break-even mark, okay? So I just want to leave that hanging there, okay? Should we just simply pay something to make sure We are protecting our business from any form of suspicion or red flag. So again, I've done five-year tax planning here, right? And again, everybody's company is going to be different on their journey. But I still want to emphasize here, potentially on year 5, you're still not paying profits tax. I'm kind of just encouraging you to think that you should probably pay something, okay? Because the goal is we want tax optimization, not tax evasion, okay? We want to have a realistic organization, okay? Taxes will have to be paid in China at some point, all right? You can't just repatriate everything out. It's not possible. So this is something I want you all to think about, obviously, okay? The next question I have for all of you is tax planning even possible if regulations are consistently changing in China? And I think tax planning probably, I mean, I struggled myself on this slide here. I struggled to create an example for year 4, year 5, because for me, there were just so many, what if the tax rate changes? What if? And I can't even answer I can't answer those questions because I myself don't know, right? So it does get a bit tricky, but that doesn't mean that at least for year 1, year 2, year 3, you can't do some form of tax planning. And then don't forget, your budget is something that should be continuously monitored and forecasted, right? Or reforecasted. So it's something that you are continuously updating as each year goes by, right? So, you can create, let's say, a 3-year budget. You have an inkling of what the taxes look like. You probably won't be profitable, but to do year 4, year 5, that might take a bit of creativity to work that out, okay? But like I said, there are ways of minimizing your tax exposure through these repatriation strategies, or through accruing a lot of expenses, or whatever it might be, right? Or accruing a lot of costs of goods, etc. So you can do it. The question is, should you do it? Does it make sense to do it? Does it give you a real picture of business if you do it? Or should we just be paying some? Okay. And obviously what that rate will be and how it will be applied to you will depend in 5 years' time what the tax obligations will be. All right. And that's very difficult for me right now to answer. My assumption is that the 25% profits tax rate will remain. The question will come with all of the others, whether those will still apply. So I would love today for you to tell me what your takeaways are. Give me one takeaway, because I do want to get to the Q&A, although no one's typed in anything for Q&A. What has been your one takeaway from today's session? All right, please do let me know. Angela and Pascal, I'm going to throw names out there. I'll give you guys a couple of moments to type in, but I would love to know, what is your one takeaway from today? And if there is any hand sheet for you to work on, or action plan to work on, it is, what would you have to do today to get an understanding of your tax planning in the future, right? I mean, the very simple first question is, when are you going to be profitable? Are you going to be profitable? Most of my clients start off their businesses simply being cost centers, and they remain like that for quite a certain period of time. And what I mean by quite, I mean at least for 2 years of operation. So is that your strategy? Nobody's typing to me. Monday blues. I'm guessing it's the Monday blues. So let me give you, I'll keep going because no one's writing to me. A bit sad here. No, I'm kidding. Let me give you a couple of tips, all right? So I'd love to know what your takeaway was, because it always gives me a bit of direction. But if I were to give you a tip, I'm going to give you 2 tips from this webinar session. The first is budget creation. And I would do a budget creation per month for the fiscal year, because profits tax is paid on a quarterly basis, okay? So when you're creating your budget, obviously, what is your projected revenue? What are your costs of goods or services? What are your general and administrative expenses? And then what does the EBT look like? The earnings before tax. Because that will then help you and guide you on your tax planning, right? Tip number 2, have an open dialogue with your tax officer. Okay? Your tax officer, before anybody else, will be the one who is updated the fastest about new regulations. So if you have the ability, meet your tax officer, visit the tax bureau in China, because you will get so much better clarity on how things work and how certain things are so old-fashioned. It will open your eyes to the actual system. Have an open dialogue and communication with your tax officer. You know, I always get the impression when I talk to companies that there is a sense of fear when talking to government officers, not just tax officers, but generally speaking, government officers. You have nothing to fear. Your company is incorporated legally in China, all right? You have done your first meeting with your tax officer. Why not have an open dialogue and an open communication? Have that discussion. You know, you never know what you can learn from your tax officer, okay? And the only thing is if you don't like what the tax officer has told you, you can go to his superior and ask him, right? There's a whole hierarchy within tax bureau, okay? But have that dialogue. Make the tax officer understand what you're doing. Obviously, never say that you're creating fake service agreements to get money into the country. We don't want to do that, okay? But if you are in a situation where you have to increase registered capital, you have to get your foreign debt, or you have to get these repatriation strategy agreements approved, or whatever it might be, right? Be open with your tax officer about these types of transactions, okay? Number two is, I mean, on this page, it's really set up the repatriation strategies early, get that done ahead of time. Treat FAPIAOs with respect, and tomorrow we're going to be talking about VAT, we're going to be talking about FAPIAOs, we're going to be talking about how all of that works, because that is also a tax component that we have to take into consideration. And be very precise about data and information on your invoices as well, particularly about the date of issuance, the month it's going to be allocated to, because it's very difficult to amend invoices or FAPIAOs at a later stage. And obviously all of this plays a role into your liability for corporate income tax, all right? So how we can help you in case you need help. So there's plenty of implementation and growth services that we offer, but obviously we can help with budget creation and validation. We also offer tax advisory. We can help with the implementation of an ERP system. We can do full or partial outsourcing of the accounts, the tax, the bank, the payroll, the VAT within a company. We also do health checks, and we also do internal accounting and tax compliance reviews. All right, so if anybody's interested on those, or if anybody has had questions about today's session, please do let me know. I'm going to type in the chat section this link very quickly. So if you want to have a 15-minute meeting with me, just 15 minutes to get to know you, or even any questions that you might need immediate answers for, that's a link that goes directly in my diary, and we can set up a 15-minute call to just discuss. Okay, no strings attached. Otherwise, you can also connect with me on WeChat. I'm going to give you my ID here, my email address as well, or connect with me on LinkedIn. You can find me on LinkedIn through these details. So let's get ahead on the Q&A. There's nobody here with a Q&A. Nobody has asked any questions. Didn't realize this presentation was so clear. And I appreciate your takeaway, which I actually really love, which is that Anne wrote that her takeaway is that it is less complicated than she had thought, and that the cost is also lower. And it's definitely interesting as she's getting closer to opening an office. So fantastic. So Anne, I love that takeaway, because that is actually something that people make an assumption immediately on, is that we've got to think about the corporate income tax before even actually making the analysis. When are we going to be profitable? Are we going to be profitable, right? So great takeaway. Nobody else has asked questions. Very quiet group today. All right. Well, if you guys have questions, keep typing. I'm just going to move on. So like I said, if you want to set up a 15-minute game plan session, please do. The link, as I said, is in the chat section. Happy to have a discussion with you, especially if you have got any questions. If any of you have WeChat accounts, so I've set up a China Roadmap community. If you would like to join, connect with me personally on WeChat and let me know a little bit about yourself and your company, and then I can connect you to the community. The whole point of the community is that I give updates, obviously, but it's also for people in the community to share their stories, to ask questions if they've got questions, to share their own events if they've got events. It's really to have this link with other people that have operations in China, where if you don't want to ask me, you can ask somebody that might have another experience, right? That's the whole point of the community, is to have that open dialogue where everyone is just sharing either their war stories or just asking questions because they want other people's advice or learning experiences as well. So if you are interested, let me know. And the WeChat ID is in there. Paul, very kindly, so Paul is actually a client of mine, so I put him on the spot quite a few times today. I apologize, Paul. But his takeaway is definitely to review the repatriation strategies for 2021 so that there are no issues in terms of the working capital, and sadly no questions yet. So Paul, I do know we've got a call set up for December to go through all of that already. It's wonderful to have clients that are also popping up in these sessions because it is so valuable for them too. So that's it, I guess. Very, very quiet group today. But are we ready for the next webinar sessions? There might be more questions in tomorrow's. So tomorrow we're talking about VAT, we're talking about BOPIAOs, how that all works, which is always a very enlightening session because people don't always realize the complexity surrounding VAT. Wednesday, we're going to be talking about how to avoid a tax audit. Thursday, about implementing control systems. Like I said, I highlighted that client of mine, unfortunately, that got that issue with an employee. And then on Friday, we're going to be talking about developing profit repatriation strategies, all right? Which again, are not as complicated as most people assume they are. So if you haven't registered yet, go to woodburnglobal.com/events and definitely register through those. I want to thank everyone today for joining me. It's been a real pleasure, and I hope to see you again for the next 4 sessions. So thank you and goodbye. I'll be hanging on here for another 5 minutes. So if you do want to type something up or you have a question, I will be hanging on for another 5 minutes. Talk to you all soon. Goodbye.